What if the absolute best way to beat the smartest, most highly paid minds on Wall Street is to do absolutely nothing?
Yeah, which sounds crazy.
Right. I mean, I want you to imagine staring down this massive army of financial analysts, people working 80-hour weeks, running supercomputers, analyzing every grain of data on Earth.
Flying in private jets to interview CEOs.
Exactly. All of that. And now imagine beating them just by sitting on your hands.
That sounds like a joke? Or like some kind of late night infomercial scam? But mathematically, it is exactly how the modern financial world operates.
Welcome to this deep dive into the source material. Today, we are looking at the life, the philosophy, and honestly, the somewhat conflicted legacy of John C. Jack Bogle.
Yeah, we have a really fascinating stack of sources in front of us today.
We do. We're pulling from Vanguard's 50th anniversary retrospective, a bunch of academic reviews of index fund performance, historical accounts, and obviously Bogle's own interviews and investing rules. And our mission here is to explore how a strategy that was once literally mocked by the industry, treated as a complete joke, ended up revolutionizing global finance.
If we connect this to the bigger picture, Bogle didn't just invent a new financial product to sell.
Right.
He shifted the entire power dynamic of Wall Street. I mean, for a century, the power belonged to the brokers, the middlemen, who basically guarded the gates of the stock market.
Yeah, the gatekeepers.
Exactly.
Yeah.
Bogle stripped that power away and handed it directly to the everyday investor.
He really did. And, whether you are currently staring at your 401k in a total panic or wondering if you're saving enough or just wondering why financial advisors charge such exorbitant fees, this deep dive is going to clarify a lot for you.
Oh, definitely.
We're going to reveal exactly why the most boring, hands-off strategy you can possibly imagine is mathematically the most powerful weapon you have for building long-term wealth.
It really is a story of how simplicity conquered complexity.
Yeah.
But the great irony of this massive, world-dominating strategy is that it actually started out as a monumental failure.
Okay, so if human nature begs us to try and win, why did average investors eventually stop fighting and embrace this?
Well, to understand how index investing conquered the world, we first have to understand why it was initially such an embarrassing disaster.
Right, the early days.
Yeah. And to do that, we have to look at Bogle's obsession with the costs of investing, which actually started incredibly early.
Yeah, back in 1951, I think.
Exactly, 1951. He wrote his undergraduate thesis at Princeton University. And right there, as a college kid, he was already highlighting that high mutual fund fees were a massive, massive drag on an investor's performance.
Which is pretty incredible foresight for a student.
Totally. And that 130-page thesis actually got him hired by Walter Mergen at the Wellington Fund.
Oh, wow.
Yeah, and for a while, Bogle was a rising star in the traditional Wall Street system. He climbed the ranks, eventually becoming chairman of Wellington's mutual funds in 1970. But then he pushed for a corporate merger.
A merger he later described in his own words as, quote, extremely unwise.
Yes, it was a disaster, a major culture clash, and the fund's performance just tanked.
So what would happen?
He was fired in 1974.
Wow.
He later called the whole ordeal shameful, inexcusable, and a reflection of his own immaturity. It was the biggest mistake of his career.
But the fallout from that firing, the specific legal mechanics of his termination, is what accidentally changed financial history.
Exactly. Because of the terms of his departure, he was slapped with a non-compete clause.
Right.
He was strictly prohibited from managing money directly on behalf of clients.
Which, as you can imagine, is a pretty big problem if your entire career is in investment management.
Yeah, it's basically a career death sentence.
Right. So he needed a way to run a fund without actually managing the money in the traditional sense. He couldn't be the guy picking which stocks to buy and sell.
So he found a loophole.
A very clever loophole.
He decided to follow an existing index, one created by Standard & Poor's. He created a fund that just passively mimicked the S&P 500.
Because a computer was just blindly buying the 500 largest companies, right?
Exactly. He didn't have to oversee any individual stock picks, which meant it completely bypassed his non-compete clause.
So he founded Vanguard in 1974 with this incredibly unique mutual structure. And we should probably explain what that means because it's vital to why this worked.
Yeah, definitely.
Usually, a mutual fund management company is a separate entity that wants to extract profit from the investors in the fund.
They want their cut.
Right. But Bogle set it up so that the management company was actually owned by the funds themselves.
Which is revolutionary.
Yeah. and therefore it was owned by the investors. It operated more like a nonprofit credit union than a Wall Street bank.
And then in 1976, he launched the first index investment trust, which is what we now know as the Vanguard 500 index fund.
Right. And you have to picture the hype they tried to build around this. The expectation was to raise, between $50 and $150 million in the initial underwriting.
That was the goal, to prove this new passive model could work.
And what did they actually get when the doors opened?
$11 million.
$11 million, which is, frankly, nothing in the financial world.
Basically pocket change for Wall Street.
Yeah. Bogle himself, in his characteristically blunt style, called it an abject failure.
And the rest of the industry mocked it mercilessly.
Yeah.
I mean, they literally called it Bogle's Folly.
Competitors and critics called it a cop-out. The sources even note that some prominent people in the industry called it un-American.
Wait, really? Un-American?
Yeah. The argument was that America is built on striving for greatness, so simply settling for being mathematically average was basically giving up.
We have to remember the psychology of Wall Street at the time, and honestly today as well.
Sure.
The entire culture is built on the premise of exceptionalism.
Yeah.
It's built on the idea that with enough research, enough intelligence, and, enough hustle, you can outsmart everyone else and find the hidden gems.
Right.
To tell these masters of the universe that they were wasting their time was deeply offensive to their egos.
Right. It's like, imagine getting fired from a Michelin star restaurant, and out of spite, you decide to open a factory that just makes perfectly average, plain white bread.
Just basic bread.
Yeah. You don't try to make it fancy, you just make the most basic bread possible. And then somehow your plain bread takes over the entire global culinary world, putting all the fancy chefs out of business.
That is a perfect analogy.
But I have to play devil's advocate here because the Wall Street guys kind of have a point about human nature.
Okay, let's hear it.
Isn't it human nature to want to win? Like, why would you, as an investor, voluntarily sign up to just be average?
And that is the exact psychological hurdle Bogle had to overcome. It feels wrong to aim for average.
Yeah, it feels like settling.
But the reason investors eventually stopped trying to beat the market and fully embrace Bogle's folly comes down to one absolute reality.
Which is?
The ruthless, unyielding math of compounding costs.
Okay, let's unpack that math. Because Bogle had this famous rule, right? Forget the needle, buy the haystack.
Yeah.
Don't waste your time looking for the one winning stock or the one winning actively managed mutual fund. Just buy the whole market. But why?
Because the effort to find that needle comes at a very steep price. And that price is what Bogle called the croupier's take.
Ah, the casino analogy.
Exactly. Think about being at a casino roulette table. The house always gets its cut, regardless of whether you win or lose your bet.
Right.
In the financial world, the croupier is the active fund manager, the broker, the trading platform. They take their fee off the top every single year, regardless of whether your portfolio goes up or down.
The sources have some wild numbers on this. What does that croupier's take actually look like?
Well, as of the end of 2024, the average active fund expense ratio was 0.59%.
Okay.
Meanwhile, the average index fund expense ratio was just 0.11%.
Okay, wait. I can hear you listening to this and thinking 0.59% versus 0.11%. We are talking about fractions of a single percent.
That sounds tiny.
Yeah, does that really matter? Explain what an expense ratio actually does to a person's money over time.
It matters immensely, and it's the biggest blind spot for most people.
Okay.
An expense ratio is the percentage of your total assets that the fund management takes every year to cover their operating costs and, frankly, to pay their own salaries.
Right.
So if you have $100,000 invested, an actively managed fund taking roughly 0.6% means they skim off $600 this year.
While the index fund taking 0.11% skims off just 110.
Right.
Which, still sounds like a small difference until you zoom out.
Exactly. You have to factor in the miracle of compound interest over a lifetime of investing.
Yes.
Every single dollar you pay to Wall Street in fees is a dollar that is permanently removed from your account, which means it is a dollar that cannot compound for you over the next 30 or 40 years.
You aren't just losing the fee.
No, you are losing decades of exponential growth on that fee.
Here's where it gets really interesting because I love to think about it like running a marathon.
Oh, the rudder analogy.
Yeah. The active fund managers are wearing these incredibly high-tech, expensive running shoes, but they're forced to carry a 10-pound backpack filled with their high fees, trading costs, and, the taxes they generate by constantly buying and selling.
Right, all that drag.
Exactly. The index fund, on the other hand, is just running barefoot. No fancy shoes, but zero weight on its back.
In a 100-meter sprint, maybe the fancy shoes win.
Maybe. But over a 26-mile marathon, the barefoot runner carrying nothing wins every single time. That backpack of fees just crushes you.
It absolutely crushes you, and the macroscopic numbers prove it.
Let's hear them.
The savings generated by everyday people switching to index funds are staggering. Since the year 2000 alone, it is estimated that indexing has saved investors $570 billion in fees.
$570 billion.
Yes. That is money that stayed in regular investors' retirement accounts and continued to compound, rather than buying yachts for Wall Street fund managers.
But surely, out of thousands of Ivy League educated managers, people who eat, sleep, and breathe financial data, someone has a system to beat that math, right?
You would think so.
If I'm paying a premium for a brilliant stock picker, shouldn't they be able to make up for that 0.59% fee by just picking better stocks?
What's fascinating here is that we hit the most profound aha moment in Bogle's entire philosophy.
Okay.
It's not just that active managers charge too much. It is a structural reality of the market itself. I want you to really think about this. All the active managers combined, trading against each other every single day, effectively are the market.
Right. Because if one Harvard MBA is buying a stock because he thinks it's undervalued, there has to be another Yale MBA on the other side of that trade selling it because she thinks it's overvalued.
Exactly. They are trading with each other.
So it's a closed loop.
Precisely. Therefore, their gross return as an aggregate group must equal the market's total return.
Oh, wow.
It's a zero-sum game before costs. But once you subtract their high fees, their high trading costs, and the taxes they trigger, the group mathematically cannot beat the market.
Right.
After the croupier takes his cut, the active managers must underperform the very market they are trying to beat. It is a mathematical certainty.
The math literally guarantees it.
Yeah.
And the sources back this up with brutal academic rigor. They cite a famous finding by Eugene Fama and Kenneth French.
Ah, yes.
Over a 50-year period, an investor has only a 3% chance of owning an actively managed fund that actually beats the market.
Just 3%.
Let me repeat that for you. A 97% chance of losing to the simple, boring market average over your investing lifetime.
Which completely dismantles the narrative that you should pay a premium for expert stock picking.
It really does. And the ultimate proof is in the pudding. We talked about that heavily mocked first index investment trust, the Vanguard 500, that launched in 1976.
Right. The abject failure.
Yeah. If you had taken $10,000, invested it in that failure at the end of 1976, and just let it sit there, reinvesting the dividends, ignoring the news, completely walking away.
What happens?
By March of 2026, that $10,000 would have grown to nearly $2 million.
Just by doing nothing.
Nothing at all.
By buying the haystack, keeping costs incredibly low, and letting time do the heavy lifting. This is why Vanguard ultimately won the battle. Bogle transformed that $11 million failure into an empire.
The sources bring up Bogle's concept of the hedgehog versus the fox, which I think illustrates this perfectly.
I love this comparison.
Right. The foxes are the sly, clever financial institutions. They sell you complex products. They dart around trying to outsmart everyone. They charge high fees for their hyperactive advice.
Right.
But the hedgehog, the index fund, when threatened by market crashes or economic panic, it just curls up into a simple, spiny ball. It does one thing, it does it very simply, and it survives while the foxes exhaust themselves.
And Vanguard became the biggest hedgehog in the world. They grew into a $16+ trillion industry giant.
$16 trillion. It's hard to even wrap your head around that.
It is. And in doing so, they forced competitors across the globe to lower their fees just to compete. A phenomenon the industry literally calls the Vanguard effect.
But the story doesn't end with a simple victory lap, because as Vanguard grew to this unimaginable scale, Bogle spent his final years fiercely criticizing the modern financial industry.
Yeah.
And what's wild is that he didn't spare his own legacy either.
Right. You'd think the founder of a $16 trillion behemoth would just sit back and enjoy the praise.
You really would.
But Bogle was a purist. And as he watched the index revolution evolve, he became deeply concerned about where it was heading.
Okay, let's unpack this because it feels incredibly contradictory.
It does.
If you read Vanguard's 50th anniversary report, which is one of our sources
Mhm.
today, it is celebrating this massive, vibrant ecosystem. They boast about having more than 6,700 global benchmarks. And they highly promote their exchange-traded funds, or ETFs. Like, for example, their VOO ETF, which tracks the S&P 500, pull in a record-breaking $137.7 billion in new net investments in 2025 alone.
Which is massive.
But Bogle absolutely hated ETFs. Isn't it hypocritical that the founder was essentially yelling at everyone to stop trading while his own company was wildly profiting from the ETF explosion?
Well, this raises an important question about the evolution of a massive business versus the purity of a founding philosophy.
Yeah.
Bogle's core belief was buy right and hold tight. But ETFs, by their very structural nature, trade all day long on exchanges, exactly like individual stocks.
You can just log in and click a button.
Right. You can buy and sell an ETF on your phone at 10:15 in the morning and sell it at 10:45.
Wow.
To Bogle, this structure actively encouraged bad behavior. It encouraged rapid-fire speculation over long-term patient investing.
The sources mentioned that broadly diversified spiders, which are essentially ETFs that track the S&P 500, had an average holding period of just 12 days.
12 days.
12 days. Bogle designed the index fund for you to hold for 50 years, and people are flipping the entire American economy every 2 weeks.
Yeah, he felt the industry took a beautiful tool designed for long-term wealth accumulation and turned it into a casino chip for short-term speculation.
That's a great way to put it.
He even confessed later in life that he felt somewhat responsible for contributing to the creation of what he called market segment funds. Niche ETFs that track narrow sectors, which he argued are designed to be sold by brokers rather than bought and held by investors.
He didn't just sound the alarm on ETFs, though.
No, he didn't.
He was also deeply concerned about the unrealistic expectations baked into defined benefit pension plans.
This is a big one.
Yeah, and for you listening, if you work for a state or local government or a large corporation with a traditional pension, this directly impacts you. These pension funds have to project how much money they'll make in the market so they know if they have enough cash to pay retirees. And many of them base their funding on the assumption that they will get a 7.5% to 8% annual return on their investments forever.
Which Bogle argued was mathematically delusional in the modern economic environment.
Delusional.
Yeah, he wasn't just guessing either. He had a specific, fundamental model for predicting long-term stock market returns, and he urged people to look at the mechanics, not just the historical averages.
Yes, let's break down that predictive model because it strips away all the magic and makes the stock market so easy to understand.
Okay.
He said total returns come from three things. First, you take the current dividend yield, so the actual cash companies pay you.
Right.
Second, you add the expected earnings growth rate, how much more profit the companies will make. And third, you subtract any speculative drop in the price to earnings, or PE, ratio.
And we should clarify that last part, the PE ratio, because it's crucial. The price-to-earnings ratio is essentially the hype premium.
The hype premium. I like that.
Yeah, it's how much money investors are willing to pay today for $1 of a company's profits based on how hyped they are about the future.
Okay.
If people are feeling euphoric, they'll pay a high premium. If reality sets in and they get nervous, that premium drops.
So Bogle looked at the math. Dividend yields were low, earnings growth was steady but not explosive, and PE ratios, that hype premium, were historically high, meaning they had plenty of room to drop.
Right.
When you run those realistic numbers through his model, he projected that stocks might only return 4 to 6% nominally over the coming decade.
And he projected bonds would only return around 3%.
Right. So now connect that back to the pension funds. If a city's pension plan requires an 8% return to survive and pay its teachers and firefighters, but the fundamental math says they're only going to get maybe 4 or 5%.
That is a massive structural crisis waiting to happen.
The money simply won't be there.
Exactly. And Bogle was screaming this from the rooftops while everyone else was celebrating bull markets.
And another massive warning he issued was about corporate governance. This is where his success almost became too big.
Yeah, the voting issue.
The passive revolution succeeded so completely that the big three index fund providers, Vanguard, BlackRock, and State Street, now control a massive percentage of the voting shares in almost every major publicly traded company in America.
Right. When you buy an index fund, you're giving your money to Vanguard, and Vanguard actually holds the shares,
They hold the real stock.
which means they control the voting power at the shareholder meetings.
Exactly. Bogle warned that concentrating that much corporate voting power in the hands of a few giant unelected asset managers does not serve the national interest.
It's a huge concentration of power.
When the big three essentially own the whole market, who is holding corporate executives accountable, who is challenging exorbitant executive compensation or pushing for better business practices?
Nobody. Because the indexers are inherently passive.
Right. They must own the stock regardless of how poorly the company is run. They can't sell in protest.
It's the ultimate paradox. He created a monster that did exactly what he wanted it to do. It bought the whole haystack to save everyday investors money.
Yeah.
But it worked so incredibly well that it threatens to distort the very market it was built to passively track.
The conflict is just deeply fascinating because Vanguard's modern business expansion relies on offering more products, more specialized ETFs, more global benchmarks to capture more assets.
Yeah.
But Bogle's purist philosophy was almost comically simple.
He believed an investor should just buy a simple 60-40 balanced fund.
Right. 60% total stock market for growth, 40% total bond market for stability.
And then throw your financial statements in the wastebasket. Do not open them. Only look at your balance upon retirement.
And as he famously joked, you should probably have a cardiologist present in the room when you finally do open that envelope 50 years later.
Because the shock of seeing how much wealth the boring math of compounding is generated might literally give you a heart attack.
It perfectly captures his worldview. The less you do, the less you look, the less you fiddle and trade, the richer you will be.
So if we pull all this together, what does this mean for the listener?
Well, if we look at the core philosophy of John C. Bogle, it boils down to an incredible discipline. Stay the course.
Stay the course.
Keep your investment costs as close to zero as humanly possible. Ignore the daily chatter. Tune out the financial news networks screaming about impending doom. Pass on the hot stock tips from your neighbor.
Definitely skip the hot stock tips.
Yeah, and accept a profound truth about the financial world. You get exactly what you don't pay for.
Every fraction of a percent you refuse to hand over to the croupier at the Wall Street casino is a fraction of a percent that stays in your pocket, compounding exponentially, decade after decade.
For you listening, whatever your financial goals are, this deep dive is ultimate proof that your best financial move is likely the most boring one you can make. Automate your investments into broad, low-cost index funds. Strip away the heavy backpack of fees. And just let time do the heavy lifting. Don't try to be the clever, hyperactive fox. Be the boring, unkillable hedgehog.
But as we close, there is one final, somewhat provocative thought to mull over, which emerges directly from these sources.
Oh, lay it on us.
And it's something to think about the next time you hear someone pitching a passive fund. It's the ultimate paradox of the index revolution.
Okay.
We established earlier that active managers mathematically are the market, right?
Right.
They're constant, aggressive, trading against each other, digging into balance sheets, fighting over valuations. That is what processes information and establishes the fair price of a stock.
That's how we know what a stock is worth.
Exactly. This is the mechanism of price discovery.
Right. They do the hard work of figuring out what a company is actually worth.
Exactly. Well, if Bogle's dream fully comes true, and literally everyone decides to be a hedgehog, if everyone buys the passive haystack, instead of trying to find the needle, who is left to set the prices of the stocks inside that haystack?
Oh, wow.
If the high-fee, hyperactive foxes all go extinct because no one will pay them anymore, can the passive hedgehogs actually survive on their own? Or does passive investing absolutely require a baseline ecosystem of active speculators just to function?
That is a mind-bending question. If everybody is just riding in the car and nobody is driving, how does the market know where to go?
Exactly.
But, until that theoretical day comes, the math remains undefeated.
It really does.
Usually when we think about taking on the smartest, most ruthless competitors in any field, we assume we need to fight harder, work longer, and outsmart them at every turn.
Right, that's the American way.
Yeah. But Jack Bogle proved that when it comes to Wall Street, the absolute best way to win the game is just to refuse to play it.